Okay, let's unpack this. Imagine a pharmaceutical company that just received approval for a breakthrough drug,
Hmm.
or, a tech startup that's suddenly ready to scale globally.
Mhm.
They need a massive investment to build out infrastructure.
Right. We're not talking about a simple loan here.
Exactly. They need billions. Serious, long-term structural capital. Where does that enormous influx of permanent capital actually come from?
It doesn't come from a single bank account or some giant vault. It comes from an incredibly complex yet fundamentally organized system,
The securities
the
market.
securities market.
Yeah.
But the mistake most people make is treating it as one monolithic thing.
Yeah.
Crucially, that market is divided into two distinct interconnected arenas. And if you understand these two arenas and their relationship, you understand the engine that fuels almost all modern economic growth.
That's our mission today. We're going to take a deep dive into those foundational structures. We want to focus on helping you gain absolute clarity on the two fundamental segments, the primary market and the secondary market. And we want to structure this information so you walk away with immediate, usable knowledge that cuts through, all the usual confusion you hear in financial news.
We can start right now with a powerful analogy, of which our sources define perfectly, to really set the stage for how these two structures function differently.
I love this analogy. It makes everything click immediately. So, the primary market is the car dealership. You walk in, you buy a brand new vehicle, and your investment goes straight to the manufacturer, the company itself.
To the issuer, yes.
They use that money to build more cars, more factories, and to fuel their growth. It's the place where capital is, newly forged for the very first time.
And then there's the secondary market. That's the massive used car website, like a huge continuous trading platform that's always on.
Okay.
When you decide to sell that car 6 months later, the money just trades hands between you and the new buyer.
To investor.
Two investors. The original car manufacturer doesn't receive a single penny from that transaction. The secondary market is absolutely essential for liquidity, but it doesn't raise $1 of new capital for the company that issued the stock.
And that distinction where the money goes, that's everything. So here's what we're going to cover in detail. We'll define both markets. We'll dive into the mechanics of an ITO, covering crucial differences like a fresh issue versus an offer for sale.
Which is so important to understand.
It really is. And we'll finish by exploring the strict risk management systems, like the complex architecture of circuit breakers and novation that are designed to keep this multi-trillion-dollar edifice stable and functioning. So let's start where the journey begins, at the dealership, the primary market.
Right.
At its heart, it's defined as the structured place where equity or debt funds are raised by corporations and governments from outside investors through the initial offer of securities.
And that explains its other common name, the new issue market.
A new issue.
A new issue. These are securities being issued for the very first time by the company, whether they are shares or bonds. The critical defining transactional detail here is that investors purchase the security directly from the issuer or their representatives, like the underwriter.
So the money flows straight to their balance sheet.
Straight to the company. They are actively raising capital.
And the moment a company decides to go public, it's engaging in this primary market process. This isn't just a capital event, is it? It's a profound shift in corporate strategy.
Oh, it's a total transformation. It signifies expanding the issuer's ability to raise long-term capital from a virtually unlimited number of public investors, people who were previously completely unassociated with the business in its initial private stages.
I mean, that's a huge leap.
It is. This issuance process dramatically expands the issuer's reach. They move from relying on maybe 3 or 4 large private equity funds to having access to millions of potential investors globally.
So it's the essential transformational step required for massive sustained scaling and long-term investment.
Yeah.
So beyond simply raising cash, what profound structural functions does the primary market perform for a company and, for the broader economy? The first one is just providing access to wider markets.
And breaking reliance on narrow, restrictive sources.
Absolutely.
Absolutely. Before this stage, companies often relied on well-known restrictive funding sources, angel investors, venture capital, banks.
And those come with strings attached.
Huge strings. They often come with heavy caveats, restrictive covenants, and they demand very high rates of return or significant board control. Going public via the primary market lets them move away from those restrictive demands and raise funds at much more competitive terms, often far cheaper, from a broad group of public investors. It fundamentally optimizes their financing strategy.
And this optimization starts with the crucial process of pricing the new security. The mechanics for this differ a lot depending on who's issuing what. Let's look at government debt first.
Okay, so government securities, or GSECs, are fundamentally handled through an auction process.
An auction.
Yes. Institutional investors, the big banks, the funds, insurance companies, they bid the rates or the yields they're willing to accept on that debt.
So they're bidding on interest rate.
Exactly. And the lowest acceptable rates, which means the highest prices for the government, determine the final price and yield at which that debt is issued. It's a mechanism driven purely by competitive bidding among institutions.
Okay, that makes sense. But for a private company's new equity issuance, you often use a more complex system, the book building route.
That's the standard now. For equity, pricing is done through book building. It's essentially a guided assessment carried out between the merchant banker, who's the lead manager, and the issuer.
And what are they trying to do?
They're trying to gauge the true market demand and the price appetite across various investor classes before setting a final price. This ensures the issue is fully subscribed at the best possible valuation for the company. We can get into the weeds on how that works in a bit.
Okay. Now here's where the primary market's value goes beyond just finance and into, really, corporate integrity, governance, and scrutiny.
This is a huge piece of the puzzle.
When you go public, you aren't just taking money, you are signing up for a dramatically higher standard of corporate behavior and transparency.
Precisely. The first critical result is ownership diversification.
Right, because you have all these new owners.
Hundreds of thousands of them. When a company issues shares to the public, all these new subscribers enter the ownership structure. The existing promoter's stakes naturally reduce and ownership becomes broad-based.
And that enables that crucial separation of ownership and management.
A necessary but very complex hallmark of mature public corporations.
That separation is so critical, isn't it? It addresses the agency problem, where managers might act in their own best interest, not the owners.
Exactly. And that's why the role of independent directors is so massive here. They sit on the board explicitly to represent the interests of public shareholders, those people who bought shares in the IPO, and they significantly enhance the governance standards of the company. Their presence is meant to be a check and balance.
Offering new investors confidence that decisions are being monitored.
For fiduciary duty, yes.
And this governance structure is only effective because of the high disclosure standards required in the primary market.
It's absolutely foundational. Any business seeking capital from new public investors must provide relevant, accurate, and verifiable information in the prospectus and all the filings.
No hiding.
No hiding. This rigorous disclosure process ensures that new investors can make informed decisions based on transparent data. And our sources stress that the evaluation involves layers of scrutiny, not just from auditors and regulators, but intensely from investors, financial analysts, and the media the moment an IPO is announced. That's a level of public scrutiny private companies never, ever face.
And while the primary market is about funding the company, it also provides an essential function for the founders and early backers.
The exit for early investors.
Yeah, that's often overlooked.
It is. The primary market offers a structured exit option for promoters. And those early-stage venture capitalists, the ones who took the initial enormous risk to sell some or all of their holdings and realize their profits.
So it monetizes that initial risk they took.
After the company has successfully established a performance record and is now publicly visible, yes.
And finally, the primary market instantly, almost artificially, creates liquidity even before the first trade happens?
It does. It does so by two actions. First, distributing securities to a large number of investors, so there are plenty of potential future buyers and sellers. And, critically, by mandatorily listing them on an exchange. That listing immediately opens up the secondary market for easy trading. Without the primary market and its listing requirement, there is no subsequent, highly liquid secondary market for that security.
And let's just reiterate the regulatory objective here. It's peer protection.
The supervision is paramount. Its primary objective is investor protection, ensuring fair procedures in the issuance process, guaranteeing accurate information is disclosed, and making sure that the rights and obligations for all parties involved are clearly defined and enforceable.
Okay, let's clarify the different types of issues we see in the primary market, because that dealership doesn't just sell one model of car. Not all primary issues are public.
That's a key distinction we need to emphasize. We can categorize them broadly into public issues and private placements.
Okay.
A public issue is where securities are offered to the general public. This is either an IPO, an initial public offer, by an issuer that has never been listed before,
The first time out.
the first time out, or it's an FPO, a further public offer, by a company that is already listed.
And private placement. That sounds like the VIP section.
It's more exclusive, yeah. Private placement involves issuing securities to a select, smaller set of investors. It usually targets sophisticated institutional investors.
And why would a company choose that route?
Well, this approach is often chosen for efficiency, for speed, and when the issuer wants a specific type of capital partner, one that might provide strategic advice, not just capital.
And our sources specify two very targeted forms of these: the preferential issue and the qualified institutions placement, or QIP.
A preferential issue is highly specific. It's when a listed issuer sells shares to any select person or group based on a special resolution.
Okay.
QIP, however, is the mechanism for issuing eligible securities specifically to qualified institutional buyers, or QIBs, on a private placement basis.
And QIBs are the financial giants. We're talking mutual funds, foreign portfolio investors, insurance companies.
The big players, yes.
So why do companies like the QIP route so much?
QIP is popular because it allows listed companies to raise capital quickly. They can do it without the laborious, time-consuming procedural steps required for a full public issue.
Ah, so it's less red tape.
A lot less. Since QIBs are deemed sophisticated investors, the regulatory friction is greatly reduced. It makes it an efficient path for established companies to raise large sums of money rapidly.
Okay, switching gears. It's not just private sector companies raising funds. Governments are enormous players in this primary market.
They are the largest issuers of debt, by far. Governments raise funds through government securities, or GSECs. Short-term funding needs are met through treasury bills, T-bills, while long-term needs are met through bonds. This is how the government manages its balance sheet.
And funds its budget deficit, finances public projects, all of that.
All of it.
And GSECs have this reputation for absolute safety. They're called gilt-edged instruments. That term sounds almost royal.
It's highly descriptive.
Yeah.
Gilt-edged means they carry virtually no risk of default. They're backed by the full faith and credit of the sovereign government.
So they're considered risk-free.
Exactly. And because they're risk-free, they serve as the crucial benchmark, the risk-free rate that every other debt security in the economy, from corporate bonds to mortgages, is priced against.
We also see state governments issuing their own debt, state development loans, or SDLs.
Right. Those are used to fund state-level infrastructure and development projects.
And we have to mention disinvestment. In the primary market context, this is when the government offers a portion of the shares it already holds in a public sector unit, a PSU, to the public.
Essentially, partially privatizing the asset to raise funds for the state.
Our sources also highlight specific incentives to attract retail capital into public sector debt, things like PSU tax-free bonds.
Like those issued by the National Highway Authority of India, where the interest is exempt from tax.
Yes. But a specific detail that's often missed, especially for sophisticated investors, is the role of Section 54EC.
That's a very specific tax detail. Section 54EC allows investors who have realized long-term capital gains from selling certain assets, like property,
Right.
to claim a tax exemption on those gains if they invest the proceeds into specific pre-approved bonds, often issued by PSUs like the REC or NHAI. This ties government debt directly into individual tax planning.
Showing how integrated the market is with fiscal policy.
Absolutely.
Okay, back to the private sector. The securities market is their principal source of long-term funds. We need to clearly differentiate the debt instruments they issue. Corporate bonds versus commercial papers.
A simple distinction, really. Corporate bonds are the mechanism for long-term debt capital. If a company is funding a massive, decade-long factory build, they issue bonds.
Okay.
Commercial papers, on the other hand, are instruments issued for short-term debt, typically less than 1 year. They're used primarily for managing daily working capital or seasonal inventory needs.
So the time horizon defines the instrument.
That's the key.
And finally, specialized vehicles use the primary market to pool capital. We know mutual funds launch new fund offers, or NFOs, but let's explain the structural trusts, REITs and INVITEs.
Right. REITs, real estate investment trusts, and INVITEs, infrastructure investment trusts, are modern structures designed to securitize real assets.
Securitize them how?
Well, REITs invest in income-generating real estate, like office buildings or shopping malls, and they derive their returns from the rent.
Got it.
INVITEs invest in operational infrastructure projects. Think toll roads, pipelines, or power grids, deriving returns from tolls or usage fees.
And for investors, there's a practical barrier to entry here compared to a normal IPO, right?
Yes, there is typically a substantially higher minimum investment amount required for units in REITs and InvITs.
And that's intentional.
It is. This structural choice gears these instruments towards institutional or high net worth investors, ensuring the underlying projects get stable, long-term funding from sophisticated parties who are less likely to pull out at the first sign of volatility.
All right, now that we've framed the importance of the primary market, let's get into the step-by-step mechanics of the most high-profile event. The initial public offer, the IPO. Who gets to be part of this?
The system is designed to be highly inclusive. The participant list is diverse. Resident individuals, Hindu undivided families or HUFs, minors through guardians, companies, and of course international players like foreign portfolio investors, FPIs.
So it's built to accept capital from pretty much anywhere.
From virtually every corner of the financial world, yes.
And as soon as the IPO happens, the shareholding pattern changes fundamentally. It moves from that handful of private owners to the public domain.
Absolutely. The ownership structure moves from being tightly held, primarily by the initial founders and early private investors, the promoters, to becoming widely held by that diverse group of retail and institutional investors. The company ceases to be a closed shop,
It becomes a truly public entity.
answerable to a much broader base of owners.
Okay, let's unpack the two most important structures of an offering. Fresh issue versus offer for sale, or OFS. This distinction is so critical because it tells you, the investor, exactly where your money is going.
It is the single most important detail in the IPO prospectus.
Okay, so a fresh issue.
When a company uses a fresh issue of shares, it is creating and issuing new equity. This action increases the company's issued share capital, and the cash proceeds flow directly into the company's treasury.
So that's the money for growth.
That's the money for funding expansion, retiring debt, or buying assets. And because new shares are created, the percentage holding of existing shareholders, the promoters, is reduced. We call that dilution.
So fresh issue means new capital for growth, but dilution for the owners. Now, the offer for sale, the OFS.
In an offer for sale, no new shares are created.
None.
None. Instead, existing shareholders, like the promoters or the private equity funds that invested years ago, sell their existing holdings to the public. Crucially, the company's share capital does not change, and the entire proceeds go not to the company, but to the selling shareholders.
So wait, if an IPO is 100% offer for sale and $0 are going to the company for future projects, why would a new investor still buy in? Should that be seen as a potential red flag?
That's a great question, and it's not automatically a red flag. While the capital doesn't fund immediate growth, the investor's incentive is twofold. First, you're buying a stake in a potentially great company, betting on its future earnings and the subsequent rise in the secondary market.
Okay.
And second, the very act of an OFS provides essential liquidity for the founders and early investors. It validates their work and potentially ensures their commitment to the remaining stake they still hold. It's often necessary to provide that exit to keep the whole ecosystem functioning.
And just quickly, why would a company that's already listed do a further public offer, an FPO?
FPOs are needed when a listed company requires significant additional growth capital, maybe for a huge merger or acquisition. Or sometimes they are mandated to increase their public shareholding to meet specific regulatory requirements about the minimum public float percentage.
Now we get to the valuation puzzle.
Right.
Pricing. What is a share worth, and who decides it?
The issuer ultimately decides, in conjunction with its merchant bankers. And this decision falls into one of two established methods: the fixed price method or the book building method.
A fixed price issue sounds simpler.
It is. The company and its lead manager determine the price based on internal performance and external valuations of comparable companies. And that single price is known when the issue is announced to the public.
But book building is the main model for large equity raises now.
It is, because it's a dynamic, market-driven process. The objective of book building isn't for the company to mandate the price, but to identify the maximum price that the market is actually willing to pay for the securities.
So it's a real-time demand assessment.
An immediate real-time demand assessment across the spectrum of investors.
And that dynamic range is defined by the price band.
Exactly. The company sets a defined range, starting from a floor price and going up to a maximum price, which is typically 20% above that floor. Investors must bid within that band, indicating how many shares they want and at what price. The culmination of all these bids determines the ultimate cutoff price.
And that's the final price everyone pays.
It's the single final price point at which the entire issue gets fully subscribed by the market, yes.
So if I bid, say, $95 a share, but the cutoff price is set at $100, what happens to my application?
You receive a full refund of your application amount. Only bidders who place their order at or above the cutoff price are successful and eligible for allotment.
I see. And let's delve deeper into how that cutoff is determined. Our sources mention the crucial role of the QIBs, the institutional buyers.
The QIB segment is key. They often start bidding aggressively early on.
Hmm.
The merchant banker closely tracks the demand from these large institutional players because their bids are seen as a strong indicator of confidence.
So they sort of set the tone.
They do. They are highly informed, and their weighted bids, often concentrated at the upper end of the price band, essentially signal the highest sustainable clearing price to the lead managers, helping them decide where to set that final cutoff.
And I understand retail investors sometimes get a small incentive in this process.
They do. In many regulatory frameworks, retail investors are permitted to be allotted shares at a small discount to the final cutoff price, sometimes up to 10%.
And that's to encourage broader participation.
Exactly. To ensure the shares aren't entirely scooped up by institutions.
Now let's talk mechanics, specifically ASBA, applications supported by blocked amount. This sounds like an obscure technicality, but it's fundamental to streamlining the IPO process.
ASBA is absolutely crucial for minimizing transactional risk and fraud. When an investor applies, they authorize their bank to simply block the application money in their existing account.
So the money doesn't actually leave your account.
Not at first. It's legally marked as unavailable, but it is not transferred or debited. It is only released and debited from the account upon actual successful allotment of the shares.
That significantly reduces the time money is tied up and eliminates the risk of bounced checks or delayed refunds.
Precisely. It makes the entire process cleaner and more efficient. And when the demand is intense, we get oversubscription.
That's when the hype is real.
Oversubscription occurs when the total number of valid bids received at or above the cutoff price is higher than the total number of shares offered.
So not everyone gets what they asked for.
No. In this scenario, shares are allotted to those successful bidders on a strictly proportionate basis. If the issue is subscribed 10 times over in your category, you'll get roughly 10% of what you applied for.
We've focused heavily on equity, but debt securities are a huge part of the primary market. How do their issuance and regulation differ?
Debt securities are also issued via prospectus and must be mandatorily listed on a stock exchange, just like equity. However, since debt involves a contractual promise to repay, the regulatory requirements heavily emphasize credit risk assessment.
And that means relying on external, impartial assessments of solvency.
Exactly. The issuing company must obtain a formal credit rating from at least one recognized credit rating agency, like a Moody's or a Standard & Poor's. This rating, which reflects the likelihood of default, must be clearly disclosed in the offer document.
Providing debt investors with a baseline risk assessment.
That's right.
And while equity investors rely on independent directors to protect their interests, debt investors have dedicated protectors, debenture trustees.
Correct. The interests of debt security holders are safeguarded by debenture trustees, who are professional SEBI-registered banks or financial institutions. Their primary role is to ensure the company adheres to the terms of the debt covenant.
Protecting the collateral and ensuring repayment is maintained.
They act as the fiduciary for the collective group of bondholders.
One final important primary market mechanism to cover, the rights offer.
A rights offer is a method for a listed company to raise capital specifically from its existing shareholders. The shares are offered in a specific ratio based on current holdings.
And it's usually at a discount, right?
Often priced at a discount to the current market price, yes, making it an attractive opportunity for existing owners.
And what's truly sophisticated about this process is the creation of rights entitlements, or REs.
The RAs are effectively coupons that represent the right to buy the shares. They are temporary tradable assets with their own separate identifying code, an ISIN.
So you can sell the right itself.
Exactly. This provides maximum flexibility. If an existing investor doesn't want to commit more capital, they don't have to forfeit the value of that right. They can simply sell their entitlements to another interested party in the secondary market.
Monetizing their privilege without subscribing to the new shares.
Precisely.
We have successfully funded the company in the primary market, secured the listing, and issued the securities. Now that security leaves the dealership and enters the massive continuous used car website, the secondary market. Define it one more time, focusing on that crucial flow of money.
The secondary market is where securities, once issued and listed, are bought and sold in a continuous auction between investors.
between investors.
The crucial takeaway remains that the funds exchanged move only between those investors. The secondary market does not raise any additional capital for the issuer.
But its existence is vital for the primary market to even function.
It's parasitic in the best sense of the word. The primary market relies entirely on the promise of the secondary market. If you, as a new investor, believed you would never be able to sell that security later on, you would never purchase it in the first place, regardless of the company's potential. The secondary market provides the promise of an exit.
So what are the core functions that give the secondary market its indispensable value? First and foremost, the obvious one, liquidity.
Liquidity is the single greatest benefit. It allows investors to enter or exit any listed security easily and, crucially, quickly by finding buyers or sellers almost instantly at the prevailing market price.
That ability to convert a financial asset into cash with minimal delay and cost is everything.
It's what makes securities valuable and tradable.
And this continuous high-volume trading leads directly to price discovery.
This is where the market determines the real-time value. The trading price at any given moment reflects the collective assessment, the aggregated opinions of millions of investors globally regarding the fundamental worth and future prospects of a security.
All based on shifting demand and supply.
Continuous shifting demand and supply dynamics. This price is the market's instantaneous, unforgiving verdict on the company's prospects.
And that immediate valuation has a direct, tangible benefit for future primary market fundraising.
Absolutely. The secondary market valuation gives an instantaneous benchmark price at which the issuer can confidently offer new capital in future primary issues, like an FPO or a QIP.
So if their shares are trading high, they can raise new capital at a great price.
Minimizing dilution for existing shareholders, yes.
But the value goes beyond money. It's about information signaling. It's the market talking back to management.
Market prices provide instant, brutal feedback on a company's performance, profitability, and any regulatory issues. If there's bad news, say a missed earnings target or a regulatory fine, the stock price drops instantly.
Which forces them to respond.
It forces issuers to improve profitability, correct mistakes, and quickly incorporate new, accurate information into their communications. The market is constantly signaling its confidence or distress.
If the secondary market is the collective heartbeat of thousands of listed companies, what serves as the official readout, the economic barometer for the whole system?
Stock market indices, primarily the leading ones like the S&P BSE Sensex or the NSE Nifty 50, they're widely viewed as barometers of economic performance because they capture the state of financial markets at a precise point in time.
An aggregated snapshot.
Exactly.
And how are those leading indices structured to accurately reflect the market?
Most leading indices are weighted by market capitalization. This means companies with a larger total market value have a greater proportional influence on the index movement.
And that value is calculated how, again?
By multiplying the number of shares issued by the current market price.
So if a blue-chip stock with a $500 billion market cap moves 2%, it has far greater influence on the Nifty than a small-cap stock moving 10%.
Far greater. And indices also serve the pragmatic purpose of being a crucial performance benchmark for investment vehicles like mutual funds and ETFs.
Now, who are the key participants keeping this complex, continuous auction running smoothly?
We can group them into 5 essential categories. You have the infrastructure institutions, the exchanges, the clearing corporations, and the depositories.
The plumbing.
The plumbing. Then the investors, both retail and institutional, the issuers, the financial intermediaries like brokers and merchant banks, and governing them all, the regulator.
We keep referencing market capitalization. Let's formally define it again, as it's the metric used for everything.
Market capitalization, or market cap, is the total value of a company's outstanding equity. The calculation is straightforward. Take the total number of shares outstanding and multiply it by the current market price per share.
It's the public's current assessment of what the entire company is worth.
That's it.
And this market cap allows us to segment stocks, which dictates regulatory constraints and investor profiles. We hear terms like blue chip, mid cap, and small cap all the time.
Right. Blue chip stocks represent the largest companies by market capitalization. They're the established, often dependable entities characterized by high liquidity and stable performance. Mid-cap companies are medium-sized and generally have good liquidity, representing high growth potential. And small-cap stocks are the smaller companies and typically do not enjoy as much liquidity, meaning trades can disproportionately affect the price. They're generally higher risk.
And the level of trading activity itself is measured by market turnover.
Market turnover is the measure of volume and value. It can be represented in two ways. In rupees, representing the total traded value, the total amount of money exchanged, or in the number of contracts or shares, representing the total traded volume.
And high turnover signals high liquidity.
And strong investor interest, yes.
Finally, let's return to the powerful, non-financial role of the secondary market. The facilitation of corporate control. This is the ultimate governor of management efficiency.
This is a powerful systemic check. If a management team is incompetent, inefficient, or acts against shareholder interest, the information signaling function ensures the share price will drop, leading to an undervalued company.
Which makes them vulnerable.
It makes the company a potential takeover target by an outside acquirer or a corporate raider. The constant looming threat of being acquired if your stock price drops too low acts as a powerful, non-regulatory mechanism encouraging continuous performance improvement and better governance from the current management team.
When you consider that the secondary market is trading trillions of dollars worth of assets every year, instantly, across millions of transactions, it's only possible because of an incredibly strict and robust risk management architecture. What is the primary operational need for these complex safety systems?
The need is to mitigate the risk of systemic failure.
Systemic failure.
Caused by one or more members defaulting on their payment or delivery obligations. If a large brokerage firm collapses because they can't cover their trades, the ripple effect could instantly freeze or destabilize the entire market. The system must guarantee settlement.
So the first line of defense is ensuring the members themselves are financially sound, starting with capital adequacy norms.
Yes. Clearing members must maintain minimum paid-up capital and net worth requirements, which are calibrated by regulators to ensure they can sustain the volume of business they handle.
And on top of that, they must place a specific deposit called Base Minimum Capital, or BMC.
Right, and the BMC is distinct from a standard margin.
How so?
The BMC is a permanent, fixed deposit against which absolutely no exposure for trades is allowed.
So it's untouchable.
Untouchable for daily trading. It's not used to cover daily risks. It's a core solvency fund, acting as the absolute last buffer that ensures the clearing member is serious and financially stable.
And to manage the risk on individual daily trades, we use margin.
Margin is the operational tool. It is a percentage of the total trade value paid upfront by both the buyers and the sellers. This payment acts as insurance to cover the risk that one party fails to deliver the payment or the shares by the settlement date.
And here's the true innovation that allows markets to scale: novation. This technical concept is the bedrock of eliminating counterparty risk.
Novation is a fundamental legal process implemented by the clearing corporation, the CC. When you place a trade, say selling 100 shares to an unknown buyer, the CC immediately steps in and legally inserts itself as the counterparty to both sides of the transaction.
So the CC becomes the buyer to the seller and the seller to the buyer.
Exactly. The CC guarantees the payment to you, regardless of whether the original buyer fails, and guarantees the delivery of the shares to the buyer, regardless of whether you fail to deliver.
So it completely eliminates the risk of dealing with the specific person on the other side of the trade.
It simplifies settlement immensely. And should something still go catastrophically wrong, if a clearing member defaults despite all this, we have the Core Settlement Guarantee Fund, the Core SGF.
The last resort.
This is a communal fund contributed to by the exchanges and members that is used to guarantee the final settlement of trades. It ensures investors don't lose out due to a broker failure and that the market never has to stop due to systemic distrust.
Beyond solvency risk, the exchanges must actively manage volatility, risk abnormal price movements that can trigger panic.
For broad market panic, they use circuit breakers. These are mechanisms that automatically suspend trading nationwide if there's an abnormal price movement in a key index. The system is tiered.
Tell us about those tiers.
The initial trigger is typically a 10% drop in the index, which requires a halt of trading for a specific cooling off period.
45 minutes to an hour, something like that?
Depending on the time of day, yes. If the drop continues and hits 15%, the suspension is longer. If the fall reaches 20% in a single day, trading is typically halted for the remainder of the day. They literally force market participants to pause and reflect.
And for individual specific stocks, they use price bands.
Price bands impose daily limits, say 2%, 5%, 20%, on how much a single security can rise or fall in one trading day. This limits stock-specific volatility and prevents speculative manipulation.
Got it.
And certain high-risk or low-liquidity stocks are placed in the trade-to-trade segment, which minimizes volatility by mandatorily enforcing actual physical delivery of shares for every single trade.
Preventing that quick intraday speculation. Now we move to how the company directly modifies shareholder value through corporate actions after listing. Before any action, there is one crucial date the investor must note: the record date.
The record date is the critical cutoff announced by a company to determine precisely which shareholders are legally eligible to receive the benefits, be it a dividend, a split, or a bonus issue.
So if you buy the share after the record date, you're not entitled to the benefit.
You are not.
Let's start with bonus issues.
A bonus issue is the issuance of shares to existing shareholders out of the company's accumulated free reserves retained earnings that haven't been distributed.
And the shares are free.
They're distributed without any cost or consideration to the investor. It's fundamentally converting reserves into formal equity capital. However, there's a crucial restriction.
Which is?
A company cannot declare a bonus issue if it has defaulted on interest or principal payments of any existing debt securities or fixed deposits. This prevents financially distressed companies from issuing free shares to mass problems.
Then there are dividends.
Dividends are the share of the company's profits received by the shareholders, declared out of the profit and loss account. The tangible return on investment. The critical regulatory constraint here is designed to protect solvency. A loss-making company is legally prohibited from paying dividends.
So if the company is losing money, that capital must be conserved for operations.
Not distributed to owners, right?
Next, let's clearly distinguish a bonus issue from a stock split. They both result in more shares, but the mechanics are totally different.
Fundamentally separate in the company's accounting ledger. A stock split reduces the face value of existing shares in a defined ratio, say, from a $10 face value to a $2 face value, thereby increasing the number of shares held by a factor of 5.
But crucially, the company's total share capital does not change.
It does not. The fall in the nominal face value per share exactly offsets the increase in the number of shares outstanding.
So if I hold one share at $500 and it splits 5 for 1, I now have 5 shares at $100 each. My total market value is identical. Why bother?
The primary reason is accessibility and liquidity. If a stock trades at a very high price point, it can deter smaller retail investors. Splitting it reduces the nominal price per share, making it appear more affordable, which encourages greater investor participation and boosts trading liquidity.
And the final action we should discuss is the share buyback.
A buyback occurs when a company actively purchases its own listed shares from investors using its cash reserves and then extinguishes them.
Removes them from circulation.
Yes. The goal is strategic. By reducing the total number of shares outstanding, the company immediately and artificially increases the earnings per share, or EPS,
making the company look more profitable on a per-share basis,
which often acts to support or boost the share price in the secondary market. Before we move to our final thoughts, it's worth taking a moment to appreciate the sheer breadth of the term securities itself, as defined legally under the SCRA 1956.
It's a vast umbrella. We've talked about shares, stocks, bonds, and debentures, but the definition extends to derivatives, futures, government securities, and any explicit rights or interests in those underlying securities.
It truly covers nearly every tradable financial instrument used to raise or exchange capital. So we have completed our deep dive into the dual structure of the securities market. We started at the dealership, the primary market, where new capital is forged for growth.
Right. We detailed the process of new issues, from the high standards of disclosure required to the nuanced mechanics of pricing through book building versus fixed price.
And we smoothly transitioned to the continuous trading floor, the secondary market, where value is continuously assessed through price discovery and instant information signaling.
And crucially, we detailed the stringent systems designed to keep the entire structure stable and safe, from the mandatory capital adequacy and margins to the systemic elimination of counterparty risk through novation and the forced stability of circuit breakers.
So what does this all mean for you as a sophisticated observer of finance?
I think understanding this dual structure is the key to understanding where new capital originates and how that value is continuously monitored and assessed by the global community.
The primary market funds growth.
And the secondary market is the demanding, efficient, high-speed machine that validates that growth and provides the essential liquidity that makes the primary transaction possible in the first place.
Ultimately, the entire system relies on rigorous governance and radical disclosure. It's enforced by regulators, but maybe more importantly, enforced by the merciless efficiency of the secondary market itself.
Which brings us to our final provocative thought for you to consider. We detailed how the secondary market's price discovery function can lead to undervalued shares, making the company a takeover target. So we ask you to reflect on this constant underlying threat. How does the possibility of a secondary market takeover and the risk of being fired by a new owner fundamentally shape the daily decisions, risk tolerance, and long-term planning of CEOs and management teams in every single listed company? It's arguably the most powerful non-regulatory force driving corporate efficiency in the world. A great point to mull over as you see the daily tickers move. Thanks for joining us for this deep dive.
Thank